When a corporation declares dividends, there are 3 dates related to it. There's the declaration date, the date of record, and then the payment date. So in this example, we have Dalai Lama, who's issued 100,000 shares of $1 par value common stock, and it has repurchased 10,000 of those shares. On December 20th, the board of directors declared a 10-cent cash dividend, and it's going to be paying that 10 cents to those who hold the shares at the close of business on December 31, and then they're going to actually pay, write the checks on January 5th. So the first date is the declaration date, December 20th. At that date, they have an obligation. They have to record the dividend, and in this case, they're going to debit dividends. That makes shareholders' equity go down, and then they're now liable. Prior to that, there was no obligation to pay a dividend, but as soon as they announce it, they have to record the liability. Now, as far as the amount, they owe dividends only to those shares that are outstanding. So if you notice here, they've repurchased 10,000 of its shares. So the number of shares outstanding that are entitled to a dividend are the 100,000 shares minus 10,000. So the amount of the dividends is the 10 cents per share times the number of shares outstanding, which is the 100,000 minus the 10,000 repurchased. So a $9,000 liability is now going to be recorded. So we debit dividends, reduces shareholders' equity, and credit dividends payable. Now, when December 31 rolls around, that's referred to as the date of record. So there's no entry that's going to get recorded, but what will happen is that they'll update their stock records on that December 31 date, the date of record. So again, no entries recorded. It's just the amount of, or who gets the checks, and it's whoever holds the shares on December 31, which is referred to as the date of record. Now, as far as the financials go, on your statement of shareholders' equity, we'll see dividends of 9,000. On your statement of cash flows, there is no cash paid under financing activities because they owe it. So that's going to be a liability, and it'll be a current liability. So now we go into the next accounting period. It's January 5th, and it's now what we refer to as the payment date. So what's going to end up happening is they're going to pay their payable. So we're going to debit dividends payable, which will reduce that liability, and credit cash. As far as the effect on the financial statements, we have a reduction of cash. Sorry, I've got to actually do the amount here. It's the 9,000 that they owed. So the liability goes down, making it a zero balance, and then the cash goes down. Now I do want to point out here, notice the beginning balance here for dividends is zero, and that's because last accounting period, at the end of the accounting period, they do the closing entries, and they close net income, the revenues and expenses into retained earnings, and then they close dividends into retained earnings. So beginning balance is zero. So the 3 dates, declaration date, they become obligated. Got to record the liability. On the date of record, there's no entry, accounting entry. They just get the names and addresses of those who hold the shares at that date. And then the payment date is where they reduce their cash. So on their statement of cash flows under financing, it'll be cash paid for dividends, 9,000.